All right, so what happens in the event that you sell an investment property or a property held for business purpose, but you don't think you're going to be able to fully defer all taxes, meaning I don't want to replace all of the proceeds from my sale of my current property, but just some of them. Well, under the Internal Revenue Code Section 1031, that's completely fine. And it's known as a partial exchange. So here's how it works. A partial 1031 exchange occurs when you don't reinvest all the proceeds from the property you're selling, known as the relinquished property, into the property that you're going to purchase after the fact, known as the replacement property. The portion that you keep is called boot, and boot is a formal tax, essentially, term. And you'll pay capital gains on that amount, but the portion that you are able to reinvest will be reinvest on a tax deferred, not avoid, deferred basis under the Internal Revenue Code Section 1031, known as the 1031 exchange. Okay, so here's how this would work. Let's say you have a property you're selling for $500,000 and you're looking for replacement properties, and for whatever reason you find one that looks good, but that's going to be replaced at $400,000. So you have a $100,000 delta. Essentially you're selling and you'll end up with $100,000 extra than what you'll have to pay to replace with the replacement property. So that $100,000 would be considered boot, and you would pay gains on that boot. Boot can come in several different forms, and this is where people can get caught up, which is why we recommend at National 1031, you're working closely with your legal advisor and your tax advisor. Because boot could be in cash, meaning it's just net proceeds. I don't have any mortgage on my property I'm selling. I'm not putting a mortgage on the property that I'm replacing it with. It's just free $100,000 of cash flow. It can also be debt relief. Mortgage boot's an interesting concept because unlike cash boot, that's taxable, mortgage boot is taxable, but it's kind of interesting because if you made profit on the relinquished property, you think, well, why do I need a mortgage? I could pay cash for the replacement property and I can avoid the mortgage. Well, you could be facing a tax liability on mortgage boot because you have to essentially be in the same, I think of it almost like balance sheet position when you close on the replacement property as if you were on the relinquished property. So if you had, in our example, $500,000 sale and you had a $250,000 mortgage, you're buying for $400,000, you have to make sure that your mortgage boot of $250,000 kind of carries through into the replacement property because that's the balance that you had on the replacement property. Otherwise, the IRS would look at it and say, hey, you're in a better financial position here because your debt structure is different now from between the time you sold and the time you essentially repurchased. Strategic uses of partial exchanges include, accessing cash so you can pull cash out. Maybe you're just not, the inventory's tight right now. Maybe you're just not finding what you like from a replacement or relinquished property or replacement property perspective. And paying down higher interest debt, there just may be financial reasons why a partial exchange makes the most sense. The summary of this is you can absolutely move into a 1031 compliant structure knowing that you may just have a partial deferral of capital gains versus a full deferral, either by choice or just by how the replacement property selection and ultimately closing works out. Fully compliant, but you'll pay your tax, you'll pay your cap gains tax on the delta or the difference between what you sold for and what you're replacing with, including cash, mortgage, and other like-kind boot.